all from last session, nothing new.
It's all from last session?
Yeah.
All right, cool.
It's all from last session, nothing new.
Oh, this is the last session?
Those are old handouts from last session. They're all from last session. There's only one page. Use the mic.
Hey guys.
Speak louder.
Hey everyone. I'll be really brief so we can get class started. My name is Matt Kaplan. So next month, October 22nd, it's a Saturday. We're doing what's called the Stern Sleepout here on the Gold Plaza and actually in this auditorium. It's basically to raise money for homeless kids that are 18 to 25 who age out of foster care and public services but are still kids and need additional help and support. So Covenant House International, which some of you may have heard of, they're the largest nonprofit serving homeless youth in North America. They do everything from shelters to healthcare to education to job training. And a while ago, they figured out that this model of sleepouts was a good fundraising mechanism. And so there's ones that get done all over the country, and we're doing a private one here at Stern, and the administration hopes it'll become an annual event. So basically, you sign up on this page. I'll give you the link in a second. You raise money for people to support your sleep out, like if you were running a marathon or a 5K. We should ask people to have a suggested target of 1,000, but that's not like a requirement. Whatever you can do is great. There'll be programming here. It starts around 8 o'clock on that Saturday night. There's some business leaders coming. The president of Toll Brothers, we're trying to get Mayor Fulop from Jersey City, who I know some of you know. That's may or may not happen, but also a lot of the Covenant House youth will be here, and they'll talk to you about kind of their stories and their experiences. We have hot chocolate and food. We give you sleeping bags and cardboard boxes. It shouldn't be too cold, and then we all sleep outside on the plaza. I'm not kidding, by the way. So you literally, I'll give you the link. You just go and sign up and hit join team. You can see people already signed up, and then it gives you access to the fundraising platform, and it's pretty self-explanatory. If you have any questions, you can find me after class. This is the link to sign up, bit.ly/Stern Sleepout. So if you're interested, it should be pretty fun, help some homeless kids, and might be part of something that turns into an annual event here at Stern. So thanks very much for your time.
Okay, if you read my email from yesterday, we're going to start each class. It's going to sound strange, but we're going to start each class with the start of the class test. And you know what we're going to test? What we're going to be doing during the session. Sounds crazy, right? I mean, if you're testing something. But what I want to kind of bring home is much of what we do in the class you already know. So what the start of the class test hopefully will bring home is the intuition, and then say, okay, I got it. And you can fill in the details. So today's session actually brings right off what I left you with in the last session. We were talking about bias in valuation. And I talked about how every time you sit down to value a company, whether you like it or not, you bring your biases into the valuation with you. Of course, this whole problem gets magnified if you're being paid to do a valuation, and how much you get paid and what that payment is contingent on. So I'm going to present you with a series of valuation scenarios, and here's what I'd like you to tell me with each one. Whether you're going to be given, so put yourself in the shoes of whatever that scenario is. You're the appraiser valuing a company in this scenario. Tell me whether your bias will be to push the value up or push the value down, and if you can, start thinking about the levers you would start to move to deliver on that bias. So let's start simple. You have a startup, a young company, you have a startup, you're an entrepreneur. You're valuing your business for sale to a third person. Is your bias to push the value up? Is an easy one, right? You're a venture capitalist looking at this exact same business. How does this process work if I'm a venture capitalist? I come in, I invest money in your business, $1 million, $3 million. I ask for my share of spoils, right? An X% of your company. What's my bias? To make your value high or low? When I invest in you, I want to tell you you're worth nothing, because then I can claim your whole business. But right after I've invested, I want to tell everybody else you're worth hundreds of millions. It's human nature. So you're valuing your own business for divorce court. Half of whatever your estimated value is going to end up with your ex-spouse. What are you going to tell me your business is worth? Absolutely nothing. In fact, I don't know whether you've heard of this guy. I think his first name is Henry Ham. He's an oil guy. And he and his wife had this very highly publicized divorce a couple of years ago. And he came into court and he said, I'm a horrible business person. My business is worth absolutely nothing. This is the same guy who claimed his business was worth billions and fought with Forbes to be on the top 100 billionaire list. Of course, if you're the appraiser for the owner, valuing a business for tax purposes. You remember half of all valuations done around the world are for taxes. Estate taxes, income taxes. You're the appraiser working for the business person, valuing the business. Your bias is going to be to push the value down. You work for the IRS, valuing that same business. Your bias is going to be push it up. Again, none of this is magic, right? But sometimes all you have to do is stop and think. Okay? Now let's make it interesting. You're a sell-side equity research analyst. Valuing a company. I'm going to put quotes on it because I don't think any equity research analyst has ever valued a company. They price companies. It's that's a different game. Is your bias to push the value up or value down? This is a tough one. This is not as easy as the first five. Who's your client? That's really the issue, right? You're a sell-side equity research analyst. What does that mean? You're not investing your own money. You're selling your research for portfolio managers to invest based on your recommendations. This is actually the reason I say it's a tough call is there's a trade-off here. You want to deliver recommendations that work, otherwise people will stop listening to you. So you want to tell the truth. But remember how sell-side equity research works. You're put into a sector, you're given 15 companies to follow. And for the rest of your life, that's a depressing part here. The rest of your life, that's all you're going to be doing is tracking these 15 companies. And what do you need to do? You need to talk to the people in these companies. I know there are all these SEC requirements about information not being fed to you, but you look for clues. But essentially, it's like being a journalist whose primary source of information is a politician, covering that politician. It's a tough call, but you can already see why sell-side equity research is going to be tilted more towards buys than sells, because if you put a sell, guess what you're doing? You're burning your source, right? And after that, you're going to be persona non grata with the 14 other companies or even all 15 companies you're tracking. Bias in sell-side equity research tends to be towards bias for a simple reason. You need to keep these 15 companies happy for longer than you care about your clients. You're an M&A analyst working for the investment bank for the acquirer in a friendly takeover. So this is starting if you read my Tesla Solar City, so you're going to see the description play out. So you're working for the acquiring company. You've got to convince your stockholders you're getting a good deal, right? Which means what you're paying is less than what the target company is worth. So your bias is going to be, show me the target company is worth a lot more than I'm paying, and you're going to find every lever you can to push up the value of the target company. Because he said, look, we got a bargain. But here's the tricky thing. If you're the M&A analyst working on that same deal for the target company, what do you have to convince your stockholders you're getting? That they're getting a good deal too, which means the amount being paid for you is actually higher than your value. How the hell do you pull this off? And I gave you the two magic ingredients. We'll come back to these. You got to bring something from the outside, something that is created only in the event of the merger. And what is that? Synergy. Now do you see why synergy pops up in? Because that then allows both sides to declare victory, right? Because the target company bankers say, look, if we stood alone, there'd be no synergy. You're worth 7, they're paying 11, you're getting a good deal. The acquiring company bankers can start with the same 7 and say, it's true the target company standing alone is worth 7, but we're getting $9 of synergy, and we're paying only $11 for the $16 collective value. We win as well. You're the M&A analyst working for the acquirer in a hostile merger. Let's see how the game changes. You still have to convince your shareholders they're getting a good deal. So it's the same as it was in a friendly merger. But if you're the investment banker working for the target firm in a hostile takeover, what are you trying to convince your shareholders? Unlike the friendly deal, do you want this deal to go through or not to go through? You want to fight this deal. So if you're the investment banker in a target firm in a hostile takeover, you've got to convince them that what the other company is offering you is too little and they should be paying you more. So you want to push up the value. So you can already say, unless you tell me whether this is a friendly merger or a hostile merger, whether you're working for the acquiring firm or the target firm, I have no idea which direction the bias is going to cut, because I need to know what your end game is to decide what I'm going to see in the valuation. Now let's make this, I talked about sell-side analysts, right? They don't invest their own money. You know what buy-side analysts do? They work for Fidelity, they work for State Street, they work for Janus. They do research just like sell-side analysts do, but their research is entirely for internal purposes, for portfolio managers to use to decide what to buy and what to sell. So unlike sell-side analysts who have to keep 15 companies happy, buy-side analysts can track 100, 200, 300 companies. The only person they have to keep happy, to keep their job, is the portfolio manager. Right? That's all. There's nobody else you really interact with. If the portfolio manager likes what you're doing for him or her, you're home free. So in a sense, there's less of that buy bias with buy side, because there's no incentive for you to put a lot of buys and have these stocks go down, because your portfolio manager is going to be really pissed off at you. But I'll tell you what can get in the way. Let's say you're doing research on Microsoft. You decide the stock is overvalued. But let's assume your portfolio manager loves Microsoft, has 3 million shares of Microsoft. You have two choices. You can tell him what you think is the truth. Hey, Microsoft is overvalued. And I guarantee you, he's not going to take the news kindly. He's going to take it out on you. Or you can tell him, hey, you're right, that's the best stock on the face of the earth. Now again, biases can come simply from what you hold. So if you're long, do you want to be the guy who walks into Bill Ackman's office and say, this is an Herbalife thing? I think you should be buying it. Try it out. Let's see what happens. I'll walk into Carl Icahn's office and say, Herbalife, sell it short. I guarantee you will not make it out of that office in one piece. Maybe Carl Icahn will slice you into 3 pieces and send you out. So what I'm essentially saying is, when you look at a valuation, you have to look behind the valuation at the person doing the valuation and what's driving the process. So I'm going to go back to the notes, and I'm going to start off with the proposition that by now I hope is pretty obvious. You tell me who pays you to do a valuation and how much you get paid. I'll tell you which direction the bias is and how much the bias is. Let me tell you a story to bring home how strong a force this can be. So about 20 years ago, the company called Lynn Cable, and AT&T had this option to buy Lynn Cable at an appraised value. Lynn Cable was a publicly traded company, but AT&T had an option to buy 49% of Lynn Cable at an appraised value. So the time for the option to be exercised comes about, and AT&T goes out and hires Morgan Stanley. So you guys are going to be Morgan Stanley. You're going to value that 49% of Lynn Cable so I can buy it. So you work for the buyer. Lynn Cable goes out and hires Lehman Brothers. I'm sorry to do this to you, but think of yourselves as pre-bankrupt Lehman Brothers. And your job is to appraise the value of the same Lynn Cable 49%, so Lynn Cable can sell it. So you work for the seller, you work for the buyer. You're saying, what about us? I'll give you a role in a minute. 2 investment banks go to work. 2 teams grind through the numbers. They come back with 2 very different numbers. One bank comes back with $105 per share. The other comes back with $155 per share. Now I'm going to ask you to guess. Which side do you think came back with $105 per share? Morgan Stanley or Lehman? Think of which side works for whom, and the answer should be pretty clear. Which side do you think came back with 105? Morgan Stanley did. Why? Because you work for the buyer. You wanted to come in with a low value so you could buy at the low value. Lehman came back with $160 per share because they work for the seller. You could have called this even without looking at the numbers. In fact, the difference was so large, they decided to call in a third investment banker. Why settle for 2 fees when you can have 3, I guess? And they call in Wasserstein Perella. Now, I'm going to say something incredibly harsh about these guys, but I mean every word of it. These guys couldn't value a $20 bill in a brown paper bag if you put it in front of them. Single-handedly, this outfit brought down the practice of valuation about 6 notches. They've invented multiples for pretty much everything. To cash in the bag, enterprise value to cash in the bag, 3.3. Next thing you know, you'll be paying $66 for a $20 bill. But if you're Wasserstein Perella, you're right in the middle here, right? You don't want to piss off either side too much because you've got to work with both sides in the future. 105, 155, where's the safest place for you to be? Right down the middle, right? 130. They came back with $127.50, which you can take either as a reflection of their inability to do math, which would be a reasonable assumption, but it actually is an indication of something that you might want to take out of this class as a lesson to learn. Anytime you're ever asked to value something, never ever come back with a nice round number. Don't tell me the target price is $40. Tell me it's $38.83. It's amazing what that second decimal point will do in terms of creating an illusion you actually know what you're doing. When you look at evaluation, you can already see what's going to come just based on the motives. One reason that Tesla Solar City set up, I mean, after all, it's supposed to be fairness opinions, right? And if you look at the competition, the very last row in the table that I put up for the two, there's Evercore and Lazard working for the 2 sides. And at the bottom, I listed out how they were being paid. I'll give you what Evercore is being paid. $1.25 million. You say, that's not very much. The amount of work that went into their valuation, that's probably like $125,000 an hour. But here's the more troubling part. They get $5.75 million contingent on the deal happening. Same thing with Lazard. There's a $2 million fee for the valuation, and 0.4% of whatever Solar City gets as an equity value contingent on the deal happening. You write a contract contingent on the deal happening. How the heck can you expect to get on? I mean, if you really wanted honest advice here, as the board of directors at Tesla, you wanted somebody to say, does this deal make sense? The last thing you want to do is tie how you pay the appraiser to whether the deal goes through. We need some more honesty in valuation. I mean, I'm not expecting no bias. All valuations, as I said, are biased. And if you get paid, I know you're going to be biased. We need to be more transparent about our biases. Don't hide behind, oh, look at the numbers, I'm being objective. And that's part of the reason M&A valuations are such a waste of money and such a waste of time. The bias is overwhelming because the deal maker is the deal analyst. You cannot get honest advice when that happens. So my suggestion to you is the next valuation you see, before you look at the numbers, before you look at the assumptions, ask those questions. Who did this valuation? Who paid them to do this valuation? Is any of that payment contingent? on what this valuation tells me. Because if it is, you already know that there is bias in this valuation, perhaps overwhelming bias. That means the rest of the valuation becomes useless. So that's the first leg in valuation, recognizing there's bias. Here's the second misconception about valuation. If I do a good valuation, I'm going to get the right answer. Precise answer. You know when this gets started? Probably when you're 5 or 6. You go off to school, teacher comes and puts a sheet of paper in front of you. 2 plus 3. You get 5, congratulations, you got the right answer, you did everything right. You get any other answer, she says, you must have done something wrong, you got the wrong answer. And that gets drummed into you all the way through school. If I do things right, I will get the right answer. And if I get the wrong answer, it must have been because I did something wrong. And as I said, God help you if you go into one of those quant disciplines, engineer, scientist, mathematician, because this gets drummed in furthermore. You do things right, you will get the right answer. If you got the wrong answer, you must have done something wrong. You're all valuing companies, right? This will be my 30th year teaching this class, 31st year actually. Around the 10th or 11th week of this class, every single semester that I've taught this class, I know what's going to happen. About 15 or 20 of you will show up in my office, not all at the same time. My office is not that big, but staggered around the same time of the week. You'll come down, you'll put a valuation down on my desk. I'm done with my valuation. Could you take a look and tell me whether I got the right answer? And I'll tell you what I'm going to do when you do that. I'm going to push the valuation back across the desk to you and say, I don't know what the right answer is. And your faith in the system is going to crack. You say, you're teaching this class, you don't know what the value of my company is? Think about it, if I knew the value of every company, why would I be teaching this class? I don't Kauai or maybe even the big island in Hawaii, keep it all to myself. And at that stage, you can see this group splintering. One half cannot handle the fact that there's no right answer. So you know what happens to them? They become fixed income people. Now let's face it, it's a lot more comfortable sitting there with a bond, right? Somebody gives you the maturity, somebody gives you the coupon, you got to dance around default risk, but it's so much more controllable. And I let them go. It's a healthy recognition early on that valuing equity is not for you. The other half says, this is kind of neat. If you don't know what the right answer is, I can never ever conclusively be wrong. Think about this. This is one of the great things about valuing equities. You can never ever conclusively be wrong. You tell me a stock will go up. It goes down 31 years in a row. You know what you tell me? Not a long enough time horizon. It goes bankrupt. The system got in the way, right? That Lehman buy you put out in 2007 would be looking really good today, if only. I think it's kind of fun not knowing what the right answer is, but it makes people feel uncomfortable. Because when you finish a valuation, you want to check it. Right? Did I get the right answer? And I'll tell you ahead of the fact, because when you email me your valuation, can you take a look and tell me whether I got the right valuation? I'm already telling you the answer you're going to get, which is I don't know. And you've got to be okay with it, because you won't either. You cannot judge a valuation based on its precision. And here's why. I'm going to give you 2 companies to value. The first company is Coca-Cola. The second company is Twitter. So let's value Coca-Cola. We know what business it's in, right? We have lots of history. It's going to be relatively simple to value. In fact, I'll wager if we went around this room and we valued Coca-Cola, we're going to get pretty tight bounds on the valuation. There aren't that many things to disagree on. It's an established company, a mature business with a long history, easy to value. We're going to get precise valuations. Now let's say we try Twitter or Tesla. You're going to get a lot more disagreement, right? You might think Tesla is the greatest company in the face of the earth, that the Tesla 3 is going to change the face of the automotive business and come up with a value of $350 per share. And I might say, hey, you know what, they won't make it through the next debt payment that they have to make, and I think it's worth only $50 per share. The differences we're going to get in value are going to be much greater. Our valuations internally are going to be much more imprecise, not because we're not doing our jobs with Tesla, but because there's real uncertainty out there. It takes hubris to believe that just because you built a spreadsheet, you made the risk in Argentina go away. In fact, later this week, I'm supposed to be in Argentina valuing company called San Miguel. I picked it randomly. I'd never heard of it before. It actually sells lemons. I guess Argentina's a huge grower of lemons and oranges and tangerines. I've built a spreadsheet. I have a valuation of San Miguel. I'm going to put up that value, and somebody's going to ask me, are you sure about this number? And you know what my answer is going to be? Are you crazy? You're in Argentina. How can you be sure about anything being the same tomorrow? It's going to be imprecise because there are a lot more variables out of my control. But here's, I think, the irony. The more uncomfortable you feel valuing a company, and I feel a lot more uncomfortable valuing Twitter than I do Coca-Cola because there are so many more things I don't control, the greater the payoff to doing valuation. Do you see why? Anybody can value Coca-Cola. But anybody, you give me a 10-year-old who's reasonably bright and easy to bribe, candies, whatever, I can teach him enough valuation to value Coca-Cola. There's nothing there. Anybody can value Coca-Cola. So the fact that you can value Coca-Cola precisely doesn't make you a hero. It's how precise your valuation is relative to other people valuing that same company that determines whether you get a payoff. And with Coca-Cola, there is no payoff because everybody can value Coca-Cola precisely. You know what most people do with Twitter? They don't even try to value it. It's too much uncertainty. They walk away. It's when there's a lot of imprecision, a lot of uncertainty, that the payoff to doing valuation is greatest. I'll leave you with an analogy here, which might or might not make sense. Let's say you decide to drop out of the MBA program. I'm not making any suggestions you should, so don't take this as me giving you perverse advice. You decide to become a weather forecaster and go to weather forecasting school. I don't know whether there's such a school, but maybe you need good hair, be able to point at blank walls and get the right state. That's a big skill. Weather forecasting is often in TV studios. There is nothing on the wall. So you've got to point to the wall and actually get Arizona where Arizona is when you can't be pointing at California. So you get really good. You graduate at the very top of your class. And you're looking for jobs. And you get 2 job offers. And I'll tell you, even before you look at those job offers, you want to be a star weather forecaster. So think about that objective. And here are your 2 jobs. The first one is in Honolulu, Hawaii. You're saying, I don't even need to hear about the second job. I'll take that one. No, wait. The second one is in Epping, North Dakota. I don't even know where Epping is. I don't want to explore, find out where it is, but Epping, North Dakota. You think this is a no-brainer? I'll take Honolulu, Hawaii. You know why I picked those 2 cities? Honolulu, Hawaii is the most predictable weather in the United States. The temperature band is the least. And it's easy to predict whether tomorrow will be sunny or rainy based on what today is. So you know what tomorrow is going to be like in Honolulu, Hawaii? 83 and sunny. I have no idea, but I'm probably going to be pretty close to the truth. You end up in Honolulu, Hawaii. You know how many minutes you're going to be on TV? None. Everybody knows it's going to be 83 and sunny. Why do they need a weather forecaster? You're going to be delivering coffee to those anchors saying, oh, you know what, do you want an extra coffee? You go to Epping, North Dakota. Epping, North Dakota is the least predictable weather in the entire country. You're going to be wrong a lot of the time, but guess what? You are going to be the star. If you've never lived in the New York area, you should, because you're second year, you were here last winter. All we need is a blizzard in this area to figure out who the star is, right? A blizzard happens, you can see weather forecasters doing that little dance in the back room. It's me, it's me, it's me, all 30 minutes, right? You get to be the star. Why are you the star? Not because I think you can predict things well, but because you're in an environment where your prediction, even if it's noisy, is useful. So I'm going to give you some advice, and take this as advice when you go pick a company. Go where it's darkest. Value a nice Ukrainian mining company if you can. How about a Venezuelan consumer product company? That should be really good now with 15,000% inflation. You think that's absurd? That's where you're going to see the biggest mistakes. So that's a second misconception about valuation, that somehow precision is a measure of how well you can value things, when in fact that precision comes from what you're valuing, not how good you're doing the valuation. Which brings me to my third and final misconception about valuation. If I make my model bigger, it's going to get better. It's kind of built into us, right? And it's so easy to build big models now. And God help you if there's a team in the basement of your company building valuation models for you. You know what team I'm talking about? The Geek Squad. You hire a lot of Excel stars, you send them in. I don't know why the basement. I guess they can't see the light of day or they turn into vampires or something. But they love building models. Inputs come in, they never leave. So your model starts with 15 inputs and then it bloats, 25, 30, 50, 60, 80. And before you know it, there are 85 inputs to value one company. They attach a name to the model, they send it up to your desktop saying, from this day on, when you value companies, use our in-house model. Two things happen to these models. One is what I call input fatigue. Did you hear that? Let me describe what it feels like, and you can tell me whether this summer you ran into this problem or in a previous lifetime. It usually hits you around 11 p.m. on a Saturday night, and you're still at your desk. That tells you something about what you've been doing all summer, all of your life. You get ready to shut everything down. You think you're done. You can go home finally for this condensed weekend. Your managing director shows up out of nowhere. He throws a 10K on your desk and says, I want this company valued on my desk first thing tomorrow morning. Why? Sunday morning. It's his trial by fire. He wants to see how much you really want this job. Now, part of you wants to exercise your option to abandon. I won't describe it. It's deeply satisfying when you exercise it. Usually it takes the form of picking up the 10K, throwing it back in your managing director's face, and you do it yourself. That's the deeply satisfying moment. As it leaves your hand, everything after that is deeply dissatisfying. So you think about it for a moment, then you put the 10K back because you remember the rent, the car, the credit card payments coming due, and you start valuing the company with your in-house model. You get to the 12th input. The clock strikes midnight. You're not Cinderella. You wish you were, and there was a pumpkin waiting outside for you. You look down, there are 73 more inputs to go. Your stomach drops. You look at the 13th input. It says, what was the inventory 5 years ago? Now, part of you wants to go look it up, but that part's too exhausted to get out of the chair. The other part prompts you, enter a random number, let's move on. And it's amazing how quickly the random numbers roll out, right? The scary thing is when the output comes out, it all looks the same. That input you spent 3 hours over, the input you made up on the fly, they all kind of swim together. And therein is another secret in valuation. You're doing a valuation with a lot of random number inputs, and you want to hide it. You know what you should do? Create more detail in your output. Have 500 line items. Nobody will have any idea what is random and what's not. Input fatigue. The second thing is after a while you're not sure who's running who. Are you running the model? Or is the model running you? The power shifts. It's very subtle. Around 11:58, the power shifted to the model. The model starts asking you to do things. Go get me a cup of coffee. You run out there because you're afraid to piss off the model in case it might do something to you. I still remember a conversation I had almost 20 years ago with a JP Morgan equity research analyst about a buy recommendation he'd put on a stock I was fairly familiar with. The stock was trading at 35, and he put out a target price of 85. And I said, how do you come up with 85? Why do you like this stock so much? He said, I didn't do it. I said, what do you mean you didn't do it? I see your name in the report. I see the name of the company. I say 85. He said, I didn't do it. So who did it? He said, ValueMac did it. I said, who the hell is ValueMac? He said, that's our in-house model. So what did you do? Sneak into your office in the middle of the night, value the company, and leave it on your desk? But what he was trying to tell me was, look, I just entered numbers into this big model. Something happened in the model. $85 popped out on the other side. It's not my fault. The model valued the company at 85. In fact, that's often all you need to read in a report to tell you that the analyst basically says it's not my fault. The model valued the company at. So here's one thing I'm going to take off the table. You're welcome to use any of my spreadsheets to value your companies on one condition. When you turn in your final report, you know the words I don't want to read? The Damodaran model valued the company at. Don't even try it on me. I'll get really pissed off. I'll put a big X down that entire page and say, I don't buy this valuation. You can take my spreadsheet, but you have to make it your own. Input fatigue and black boxes. In fact, you can mangle some really simple assets using complex models. In the physical sciences, there's a principle called the principle of parsimony. If you've never heard of it, it's a very simple proposition. It says, when you're trying to explain something, explain it with the simplest possible explanation before you make yourself Einstein. We need to borrow on a simple proposition, that proposition in valuation. When you're trying to value something, start with the simplest model you can get away with. If you can value a company with 3 assets, don't go looking for 5. If you can value a company with 3 years of forecast, don't do 10. Because as I said, simple assets can get mangled very quickly when you use complex models. And I'll use my favorite example of a simple asset to illustrate this process. What's the simplest of all assets on a company's balance sheet to value? Cash, right? And companies have big cash balances. I know this trapped cash thing throws a little curve into the equation. We'll come back to it. But let's say you open up a company's balance sheet. You see 10 billion in cash. When you see cash and marketable securities on a US company's balance sheet, where does that cash have to be invested to qualify to be cash and marketable securities? It's got to be close to riskless and liquid, which means it's got to be invested in commercial paper, T-bills. Right now, what do you think you're making on that 10 billion? If you're lucky, maybe 0.1%, because that's what the T-bill rate is, maybe 0.25%. Let's round it up to 1%. No, I'm being very generous. You got $10 billion invested close to risklessly in liquid assets earning 1% a year. See, what's the big deal? Let's say you decide to value this 10 billion. And every week I get at least a half a dozen emails from people I usually don't know, claiming to have built a better model to value cash. So can you take a look at this attached Excel spreadsheet? Because here's what will happen. You take the 10 billion, you take the interest income on that 10 billion, right, which you're earning at 1%. You project the income out from the cash. This is starting to look like a DCF, right? You got your projected income. Once you projected the income into the future, the Pavlovian response should kick in, the one you go to business school to acquire. You got projected numbers in the future. You need what to bring them back to the present? You need a discount rate. You pull out your valuation book, your corporate finance book, cost of equity, you plug in, baby, you're off to the races. This is exactly where you spend $200,000 on your MBA. And after you plugged and chugged, you come up with a 9% cost of capital. This is excellent. You're a master. You project the 10 billion in cash with 1% income into the future. You discount that income back at a 9% cost of capital. Guess what will happen to the 10 billion in cash? It's going to become 8 billion. It's amazing. You wiped out 2 billion without even trying. You want to show me cash is worthless? Use the 30% cost of capital. Nothing has happened to the cash. It's still worth 10 billion. The reason you're messing up the value is because you're discounting riskless cash flows at a risky discount rate. It happens all the time. Anytime you start a cash flow with net income, what do you think you're doing? That net income includes the income from operating assets and the income from cash. You discount them back at a cost of equity. You are effectively doing what I just described. Don't go looking for trouble. If you have a simple company to value, and some of you will, and you can get away with valuing with 3 inputs, just stop. Don't go projecting out numbers just because everybody else in your group is projecting out numbers. So I'm going to describe this as the Bermuda Triangle of valuation. You've heard the legend of the Bermuda Triangle, right? Somewhere in the Atlantic, supposedly there is this triangle, not actually an explicit triangle, but an area of the Atlantic, where ships disappear and planes go away. I'm going to create a Bermuda Triangle in valuation. The Bermuda Triangle in valuation, good sense, goes away. And the 3 sides of the triangle are what I just described. One side is bias, that you're coming in with a lot of bias, but you refuse to admit to yourself you're being biased. You keep insisting to me that you're objective, that you're just using the numbers. The second is uncertainty, and your unwillingness to deal with uncertainty. It makes us uncomfortable. Says, what uncertainty? And the third is complexity, where you build big models. Bias, complexity, and uncertainty. We're going to flirt with each of these problems along the course of this class, because as we look at some companies, we have to deal with more uncertainty than with other companies, and we have to start to get comfortable with dealing with uncertainty. This is not about giving an equation. It's just getting okay with being wrong, because that's what's going to happen when you have a lot of uncertainty. So let me set the table on the structure for this class. There are three ways you can value an asset. There are only three ways. Hundreds of models, but only three ways. The first is what I'm going to call intrinsic valuation. Sounds fancy, but the value of an asset is based on its characteristics, its cash flows, its growth, its risk, usually captured in a discounted cash flow valuation, but not always. So in intrinsic valuation, you value an asset based on its characteristics. The second way to do valuation is pricing. To put a number on an asset, you look at what other people are paying for similar assets in the context of stocks. This takes the form of multiples and comparables. PE ratio on these 15 companies, but there's pricing. There's a third way to do valuation, and it applies if your asset has a contingent payoff. Something has to happen for it to pay off. And that's where real options or option pricing models come in. So when I look at a valuation, the first question I ask myself, is it an intrinsic valuation? Is it a pricing? Or is it an option pricing? Because I'll talk about how I often see these melded models, which are part DCF and part intrinsic value and part pricing. And those are dangerously close to crossing the line between two different ways of thinking about the number to put on an asset. Now, in doing all of this, though, at least in this context of the class, I said this was all about action, right? The reason we do this is because we think we can use our valuations to make money. So embedded in all of these approaches is an assumption about whether markets are efficient. Now, if you sat through enough finance classes at any business school, including this one, you've had your share of people who tell you, I think markets are efficient. That's fine. You think I think markets are efficient? If I thought markets were efficient, you know how long this class would last? I'd have asked you to bring the Wall Street Journal with you to class in the last session. Say, pick a stock to value, go to the journal, look up the price, class over. Because in an efficient market, there would be no point to this class. So whether I like it or not, I'm already telling you at the start of the class that I think markets make mistakes, and I also think that markets correct those mistakes. Every one of these approaches makes assumptions about market mistakes and how those corrections happen. And which approach you pick will often depend on what you think about market mistakes. So what I'm going to do with each approach is I'm going to lay out the foundations for each approach, and then I'm going to talk about what kind of assumptions about markets make that approach work for you. So let's start with intrinsic valuation. As I said, the most common version of intrinsic valuation is a discounted cash flow model. In a discounted cash flow model, the value of an asset is the present value of the expected cash flows on that asset. It's kind of the first finance class you all got, right? So when you take the present value of the expected cash flows on an asset, you're trying to estimate the intrinsic value of that asset. I have some bad news for you. Trying to estimate intrinsic value is a little bit like the search for the Holy Grail. How long have people been looking? Thousands of years. How many times has it been found? Never. But you keep the faith, you keep looking. Intrinsic value is a little bit like that. You will never get to see it, but you keep hoping that one of these days you get this massive insight that says, hey, there it is in front of you. You keep the faith. So in intrinsic valuation, you're saying every asset has an intrinsic value, and I'm going to try to see what it is before I invest in that asset. And if you break down intrinsic valuation models down, they have three ingredients. You have expected cash flows on the asset you're valuing, and you've got to come up with those cash flows. A life for that asset. So if you have a 5-year building or a 10-year rental building, it'll be the rental income you make for the next 10 years. And a discount rate that reflects the riskiness of those cash flows. You can make this as complex as you want, but it's all about a life for the asset, the cash flows over the life, and a discount rate. Now let's think about the type of mistakes markets have to make, or the assumptions you need to make for intrinsic valuation to make you money. First, you have to assume that markets make mistakes. That's an easy one. Why? Because everybody in the world will agree that markets make mistakes, including the firmest believers in efficient markets. You ask Gene Farmer, do you think markets make mistakes? Yeah, of course they make mistakes. So that's an easy one. Second, you have to assume you can find those mistakes with your metrics and models. Now you're in dangerous ground. Why? What is the track record of people collectively who claim to find market mistakes? Let me ask you another question. Remind me again how much the average active portfolio manager beats the S&P 500 by each year. It's minus 1.5%. It is the strangest business known to man. But we keep trying, right? So let's assume you're special. You found a model that actually works. So let's give the mistake a name. You're valuing Cisco. You come up with $40 per share. The stock is trading at 28. Let's say you're right. The stock should really be trading at 40. The market's made a mistake. It's trading at 28. You go out and you buy 1 million shares of Cisco at 28. Have you made any money yet? What's the third assumption you need to actually make money in intrinsic valuation? The market has to correct its mistakes. And how do you get to do that? You can get on the Yahoo message board and keep posting. Cisco is cheap, Cisco is cheap, Cisco is cheap. See how many people listen to you. You see what I'm saying? The third assumption is completely out of your control. Which means you can be right and go bankrupt being right, and your neighbor can pick stocks based on astrological signs and make millions of dollars. There's no justice in this world. And that's what you have to accept when you do intrinsic valuation. It's not just about getting the value right that's going to make you money. It's the price adjusting to the value that actually makes money, and that part of it is usually out of your control. So let's think about the advantages of doing intrinsic valuation or DCF valuation. To do a DCF valuation, we're going to come back and deal with this. You really have to understand the company and the business it's in. I know people who do it without doing it, understanding it, but if you really want to do a good discounted cash flow valuation, you have to understand the company and the business it's in. I talked about telling stories about the company. You have to start off with that understanding. And if you buy into the Warren Buffett adage of you don't buy stocks, you buy pieces of businesses, that's what he says he always does, then a DCF is actually the way to think about the world. You're not buying a stock because other people like it. You're buying a piece of a business. And if the cash flows are there, you might say, I don't care what the market thinks about it. I collect the cash flows, and I got a good deal. And in a sense, you're immunizing yourself against those lemmings, right? You're saying, I don't care what the rest of the world thinks. I'm buying this business because I like the cash flows. I'll just sit there and collect the cash flows for the rest of eternity, and I'm going to be okay. That's the advantage of DCF. You know what the disadvantage of DCF is? Every single one of these advantages becomes a disadvantage. Here's the first disadvantage. Because a DCF, a good DCF, requires an understanding of the company and the business, it requires a lot more information, a lot more inputs than a pricing does. I can price a company in 5 minutes. I need to find 15 other companies like it, find what PE ratios they trade at. I can give you a pricing. A DCF is going to take me more time. And in the wrong hands, a DCF can be played with to deliver results that are not fair. In fact, on the back of the single page you got today, I've given you a template on how to hide bias in a DCF. If you know anybody at Evercore, pass it on to them. My problem with Evercore was not that they were biased, but that they were so openly biased. So you don't show bias in the terminal growth rate. That is what you do when you've never done a valuation before. There are so many ways they could have done what they wanted to do while making it look like they were unbiased. In fact, that's what separates people who are good at valuation from people who are not. People who are good at valuation can hide their biases so well that you have to dig and dig and dig to figure out where it is. People who are bad valuation sticks out right there. Oh, okay, I can see which way your bias is. You knocked off 50% of the value because you didn't like it. So if you get a chance, look at that template, because I'm giving you a way. If you want to skew your value, I'm not suggesting it's a worthy objective, but it's easy to play with the numbers and hide your biases. And here's, I think, an issue with intrinsic valuation that we don't face up to if we're believers in intrinsic valuation. When you do an intrinsic valuation of a company, you do it company after company, is it possible to find all companies in a sector to be overvalued? Right? Basically, you take cash flow, so you take every social media company, you value every social media company. You might conclude at the end of this process that you shouldn't be holding any of these 26 social media companies, from Facebook all the way down to Yelp. You're saying, so what? Let's say you are the equity research analyst and your sector is the social media sector. What are you going to do? Put 26 sell recommendations? You know how long you're going to last as an equity research analyst if you do that? Or what if you're a portfolio manager who has to buy 2 social media stocks because many portfolio managers have sector constraints. They have to be invested in every sector. You see what I'm leading up to? If your job is portfolio management or sell-side equity research, intrinsic value can lead you into a dead end because nothing can look cheap because you're looking at every asset based on its cash flows. So when you think about the advantages and disadvantages, it's not a slam dunk that everybody should be doing intrinsic valuation. But if you ask me, when does DCF work best? The answer is pretty simple. It's going to work best if you have an asset with cash flows. You say, what kind of asset doesn't have cash flows? You ask me to value Bitcoin, and we will try. I'm going to tell you, you can't value Bitcoin. I can price Bitcoin. How about gold? The oldest asset, in fact, that investors have put their money in. Impossible to value because there are no cash flows from gold, but easy to price. It is a currency. You need an asset with cash flows. What kind of investor do you need to be to use DCF? First, you need a long time horizon. Why? What's the third leg you need for you to make money on DCFs? You need to buy something you need to first assume markets make mistakes. You find those mistakes, then what has to happen for you to make money? The market has to correct its mistakes. The longer your time horizon, the greater the chance. It's not guaranteed, even if you have a long time horizon, it's going to happen. The longer your time horizon, the greater the chance that can happen. Now do you see why most portfolio managers, even if they wanted to, would not be good candidates for intrinsic valuation? The median time horizon for portfolio managers is 3 months to 6 months. That's how long it takes before their clients come up and say, what have you done for me lately? You're already seeing yourself get pushed away from intrinsic valuation because your time horizon is not long enough for you to sit there and wait. And it's nice if you can provide the catalyst for the price correction, right? You see what I mean by catalyst? If you can somehow buy a stock that's undervalued and then get the market to correct its mistake quickly, that kind of improves your odds. What kinds of investors try to do that? Think about activist investors. One of the advantages of an activist investor, you know who I mean by activist, Bill Ackman or Carl Icahn, it doesn't work perfectly even for them. What's the first thing that Carl Icahn does once he takes a position in a company? Stay quiet and hide. The first thing he does, he's on Bloomberg in the morning, CNBC in the afternoon, giving an interview to the Wall Street Journal in the evening, saying what? Hey, I bought the stock, I want the world to know I bought the stock, and then proceed to tell you everything he thinks is wrong with the stock, most of which makes no sense, but he'd say it anyway, because he wants to be the catalyst that causes the price to correct towards a value, because then you're creating your own success. So if you're an investor saying, is intrinsic valuation right for me? I don't know the answer to it because it depends on you. What's your time horizon? What are you trying to do? Beat the market, or are you trying to kind of earn enough returns given the intrinsic risk in the investment? Because that's going to tell me a lot more about what approach works for you than my telling you this is the best approach for me. So that's the intrinsic valuation setup. Let's talk about pricing. In pricing, you attach a number to an asset based on how similar assets are priced out there. So it's very simple. Here's what you do. You have an asset. It could be anything. It could be a Mickey Mantle rookie card. It could be a ticket to a Yankee game. It could be whatever. A ticket to the Jets game 2 weekends from now. And you're saying, what will I get for it? You go look to see what other people are charging for similar assets, and you try to adjust for the fact that you have better seats than everybody else. It's in the front row rather than the 7th row. We do pricing all the time. But the essence of pricing is if you can find assets that are just like yours. Easy if you're selling tickets to a Yankee game or a Jets game. More difficult if you're pricing a stock. And very difficult to do if you're pricing a Picasso, right? Because there aren't 100 Picassos running around being traded at any point in time. So you can already see that pricing gets more difficult if you can't find similar assets which are priced out there. And let's think about the market mistake you will need to assume for pricing to work for you. When you use pricing, you are assuming that on average, markets get it right. Do you see what I mean by on average they get it right? Because in a sense, what you're assuming is they make mistakes across stocks, but the average social media stock is correctly priced. So Facebook might be cheap and Yelp might be expensive, but they can't all be expensive because you're making a relative statement. and you assume that that pricing mistake is easier to see and therefore quicker to correct. Do you see why it's easier to see? If you're the only stock trading at 7 times earnings in a sector where everybody else trades at 25 times earnings, you stick out like a sore thumb. So corrections happen quicker. So with pricing, you can see market mistakes are cross-sectional. You know what I mean by cross-sectional, right? They're cross companies. In intrinsic valuations, mistakes are across time. They get corrected over time. So the advantage of pricing is, in a sense, the mirror image of what you saw in intrinsic valuation. In pricing, you are a slave to the market. You're saying, look, I'm going to take the market as right, and my job is to beat other people playing in this market. And that's, in a sense, your job as a portfolio manager. I mean, portfolio managers don't get judged against an absolute return. They get judged against other portfolio managers who are just like them. The game is structured as a relative game. So not surprisingly, if you're measured on that basis, pricing is going to be what you pick. So when you think about being in sync with the market, that's why pricing is the weapon of choice if you have to do an IPO. Because you have to price the company, not value the company, because that stock has to be sold in the market today. In acquisitions, you're doing pricing, not valuation. So with pricing, the advantage is there will always be something that looks cheap. Why? Because it's against everything else. So if you have a sector where everything trades at, or the average multiple is 150 times earnings, a stock that trades at 120 times earnings is going to be cheap in that sector. So if your job requires you to be in a sector or in equities all the time, you're much more inclined to go with pricing. I call this the pricing game because the pricing game is a very different one than the value game. The value game, you got to get the value right and hope the price moves to the value. In the pricing game, you have a much simpler objective, which is to buy at a low price, sell at a higher price. If that comes from looking at support and resistance lines on a chart, all the more power to you. If it comes from looking at technical indicators, if it works, it works. And the pricing game is very much what I call an incremental game. You know what I mean by incremental game? Take something like an earnings report, right? What will happen to the price of a stock when the earnings report comes out? Well, they look at the earnings report and measure it against expectations, right? It's almost like the game gets condensed down to what that earnings report is. Even if it's a tiny piece of a tiny piece of a tiny piece of a company, you're focused on that tiny piece and you're looking at what that number is relative to expectations. People expected a 7-cent earnings per share. You delivered a 12-cent earnings per share. That is good. Therefore, your price will go up. You're saying that's not fair. It shouldn't go up as much. You don't care. You're playing the pricing game. So everything gets focused on incremental news, the news that's going to come out next and how it's going to affect the price. And the disadvantage of pricing is you can create a portfolio of underpriced stocks, low PE stocks, stocks which are trading at below the average of the sector, and they can all end up being overvalued because the entire market got it wrong. So when you're doing pricing, you have to accept the fact that if markets make mistakes across the board, those mistakes are going to find a way into your portfolio. And that's, I think, the weakest link in pricing. So when we look at pricing, we're going to try to see if we can stop and protect ourselves from that collective meltdown that's going to happen. One final thing about pricing that I want to bring home is when people use PE ratios or EV to EBITDA multiples or price to book ratios, and you ask them, why do you do it? One of the responses they give is because I don't like to make the assumptions you do in discounted cash flow valuations. Assumptions about cost of capital and growth and risk. Technically, that's true because you can use a PE ratio without ever looking at those. But if you dig a little deeper, embedded in every multiple are all the assumptions about cash flow, growth, and risk you made in discounted cash flow valuation. The only difference is those assumptions get made implicitly. So when you tell me that you're paying 18 times EBITDA for a company, whether you like it or not, you're giving me messages about what growth you expect in that company, how much risk you see in that company, and what the cash flows are. And one of the things we're going to talk about is how to back out those implicit assumptions and be honest with yourself about what you're assuming with pricing. So let's think about when pricing works and whom pricing will work for best. Pricing works best when you have lots of similar assets that are being priced constantly. So if you ask me to price a retail stock in the US or a software stock in the US, it's relatively simple because there are hundreds of stocks out there that are being priced constantly. That's why it works in real estate, right? because I can find other properties of transact. But even in real estate, you can see because the liquidity drops off, you don't have houses being sold and bought continuously, you need to kind of adjust the prices. That's why the Case-Shiller index, for those of you familiar, the real estate index has been so useful because it's allowed people to adjust transaction prices for the overall changes in real estate values. You know how VCs price companies? There was actually a bit of a tangle a couple of weeks ago in the Wall Street Journal. Reported that Andreessen Horowitz, which is one of the leading VC firms, it's actually an article that really shouldn't have been written because they said they're not doing well because they're not doing as well as the three very best VC firms. They were making like 50% return. Nobody's complaining about the return. They said, so it was a badly written article with a bad premise, but somebody at Andreessen Horowitz obviously did not like the article because they wanted to be number one. And one of the points they made was this article combines realized returns with unrealized returns. You know what he's talking about? In venture capital, when you look at the return on a VC, some of the returns are returns you've actually made because you bought WhatsApp at $5 million, you sold it at $78 million, that's a realized return. The rest of the portfolio, though, is based on marked up prices. So if you have a holding in Snapchat, it's been marked up to what? To the most recent Snapchat transaction. You have a holding in Uber, it's been marked up. They're doing pricing, but the problem in venture capital pricing is, unlike public market pricing where you have dozens of stocks that are traded all the time, in the VC portfolio, the companies that they hold don't get traded very often, so it's pricing based on much smaller samples and much more dangerous single observations. So it's pricing, but it gets much dicier because you don't get the law of large numbers working in your favor. So to really price something, you'd like to find lots of comparables that are priced. And who does pricing work best for? It works for people with shorter time horizons. So if you have a 6-month or 1-year time horizon, pricing works better for you than intrinsic valuation. It works better if you can take advantage of both sides of the pricing game. Do you see what I mean by both sides? You know the advantage that hedge funds have over mutual funds? Mutual funds can only go long. So when they find something underpriced, they can buy and hold. When they find something overpriced, they can avoid it, but they can't sell short. If I let you sell short, then in a sense, the market can be wrong and you'll still make money because all you're making money are on convergence towards an average. So you buy the cheapest stock, you sell the most expensive, and you hope they move towards the middle. And when that happens, you're going to make money. So hedge funds, for instance, are much better candidates for pricing than traditional mutual funds. So again, pricing is not for everybody, but if those characteristics, short time horizon, take advantage of both sides of the mispricing, fit you, I don't see why pricing shouldn't be a weapon of choice. Which brings me to a little detour. When I described the 3 ways you can value something, and I said you could do intrinsic valuation, you can do pricing, or you can do real options. I'm sure some of you came through accounting backgrounds or in appraisal firms, probably said, well, what about liquidation valuation? What about sum of the parts valuation? What about accounting valuations? It's true that there is another way you can approach valuation, but rather than value an entire company, you can value it based on its assets. You can value asset A, asset B, and add them all up. So that's what you're doing with the sum of the parts valuation. You're taking Disney and saying, let me value ESPN. Let me value Marvel. Let me value whatever the piece of Disney you're looking at. Then add up all of those values and say, this is the valuation of Disney as a company. It works best if the pieces are separable. You know what I mean by separable? If you have too many things that they're interlocked on, it's very difficult to do a sum of the parts valuation. But asset-based valuation, you're valuing from the bottom up, taking the individual assets and adding them up. You're saying, why isn't this a third way of doing valuation? Because I've asked you, how are you going to value ESPN? There are 2 ways you can value ESPN. You can do an intrinsic valuation of ESPN, or you can price ESPN. So let's face it, even when you do an asset-based valuation, if you dig below the surface, those numbers you're attaching to the assets come from either doing an intrinsic valuation or a pricing. So we will do a session on asset-based valuation, and what we will draw on are the intrinsic valuation, the pricing techniques we've already developed to do a valuation from the bottom up or a pricing from the bottom up. But that's why it's not a separate way of doing valuation. Which brings me to a question that I'll come back to at the very end of this class. It's too early in this process, but I'm going to make you pick right now, even though you haven't or might not have any experience with the 3. So I've talked about discounted cash flow valuation, and I've talked about pricing. And some of you might have experience with doing either. So at this very the start of the class, before you kind of immerse yourself in the techniques, just pick what you think is the way you think about assets. Are you more of an intrinsic value person? You want to value assets based on their fundamentals? Or do you think pricing is what's going to attract you? And then at the very last class, I'm going to come back and ask you this question to see if your experiences through the class have changed your choices. Because in this class, about 20% of the class usually changes their choices during the course of the class. Usually from intrinsic valuation to pricing, because after trying to do an intrinsic valuation of a company, you might decide at the end of that process that this is just not for you. That's fine. So I'll come back and use the same question to see if that change has happened with you. Which brings me to my third and final approach to attaching a number to an asset, which is draw an option pricing. Step back and think about what makes an option an option. First, it's a derivative asset, right? So there's got to be some underlying asset. An option is a leech asset. It cannot exist on its own. It's got to attach itself to something. So the first thing you're looking for is, what is that underlying asset? And second, options have contingent payoffs. Something has to happen for you to get paid off. In fact, the best way to actually identify options is, rather than use words, is to do a payoff diagram. See? So this is actually a classic payoff diagram for a call option or put option. And what makes option payoff diagrams unique is that kink, right, at the strike price. So with the call option, if you drop below the strike price, your losses get limited to whatever you paid for the option. With a put option, if you get above the strike price, so it's a limited loss feature that makes options what they are. It also means that with options, you get a very different perspective on risk. With traditional discounted cash flow valuation and pricing, when I increase the risk of an asset, what should happen to its value? Same cash flows, more risk, the value should go down, right? With an option, I increase the risk of the asset. What happens to the value of an option? It goes up. It's like magic. When you look at this graph, you can see why. Think of what kind of risk worries you. Is it downside risk or upside risk? It's kind of a silly question. Who worries about upside risk? It's downside risk that worries you. And with an option, what have I done with your downside risk? I floored it. I said you can't. So by cutting off your risks, I'm effectively making risk your ally rather than your enemy. So when you think about option pricing in option pricing classes, usually it's in the context of listed options. So it could be contingent value rights, it could be warrants. I'm not going to touch any of those listed priced options in this class because there are other forums you can learn about them. In this class, the way I'm going to use options is in unconventional ways. I'm going to value businesses that have option-like characteristics. Like what? Like if you give me equity in a deeply troubled firm. What do I mean by deeply troubled firm? A company that's losing a lot of money with a lot of debt. I'm going to argue that the equity in that company takes on the characteristics of a call option, and I'll tell you why. When you give me equity in a company like Petrobras, and I mentioned this in the first class, I'm getting an option because those undeveloped oil reserves, even though they might not be viable today, have an option quality to them. When you give me stock in a publicly traded biotech firm, a young biotech firm with a patent working its way through the pipeline, I'm going to argue that that stock is more like an option. Or if you give me a company with an exclusive license to do something, I'm going to argue there's optionality. In fact, I'm going to go as far as to say that if you buy any real estate property in New York City, especially in Manhattan, there's some optionality in that property. You know why? This is one of the most highly regulated real estate markets in the world. Every square inch of Manhattan is already spoken for. I'll give you an example of how much this affected us. When they first tried to build this building in 1992, they thought $60 million was a lot of money, until they realized it was New York City. So the architect came up with this 14-floor building. And for 2 years, they showed us the models of the buildings. It'll be you're on floor 12. That'll be the finance department. And somewhere, just as they were going to break ground, the architect showed up for a faculty meeting, and he said, "Looks like we made a mistake. We have to lop off 3 floors." Shock! What do you mean lop off 3 floors? It turns out that there's a certain amount of square footage of building that can be built on this space. And when they built Kohl's, the rec center, which they're now knocking down again, I don't know how they did this, but NYU borrowed space from this area and used it in the Kohl Center. Don't even ask me. The brain just goes, somersault, saying, how the heck does that happen? So you can see how when you buy a real estate building in New York, it's not just the 7 floors and the square footage you're buying. You're thinking about how many more floors can I build? And if you have the capacity to add 12 more floors in that space, you're going to pay an option value on that building, because even though you're not going to build those floors today, you have the option to build those 12 floors. There is no option value in real estate in Kansas City. So don't do stupid things by saying, I'm going to pay a premium for every real estate building. Because one of the reasons Manhattan has option values, it's an island. Right? You can't keep spreading sideways, so in a sense you've got to go up. So you already see that options are going to help us attach value to some assets that otherwise we wouldn't be able to value. And it will also change how we think about value. And in particular, we'll talk about how risk becomes your ally with some kinds of investments because of their optionality. So as we go through this class, we will bring in option pricing, but only in context. Now, one of the disadvantages we're going to have when we try to apply option pricing models to value a biotech company or natural resources is option pricing models, as we know them, were designed for basically listed options in the CBOE, 3-month options, 6-month options. So option pricing models were designed for listed options on publicly traded stocks with short maturities. The options we're going to be valuing as real options, which is what we call these, will tend to be really long-term on underlying assets that are difficult to observe. For instance, valuing a patent is going to be really difficult to do with an option pricing model. So with option pricing models, we're going to kind of stretch the limits of the model. We'll talk about what we might have to do to adapt these models to make them fit. The other thing is we have to be careful about double counting. You do a valuation of Petrobras, a traditional DCF, you can't just add the value of the undeveloped reserves on top of that valuation, because you might be double counting by using a higher growth rate in your cash flows. So we have to talk about what you need to do to make sure you don't double count for options when you do traditional valuation. So bottom line, there are lots of different ways of valuing an asset. You can fall into the intrinsic value bucket, the pricing bucket, or the real options bucket. So from this point on, whenever you see a valuation out there, whether it's from a bank, an appraisal firm, a consulting firm, or even a corporation, start thinking about, what am I looking at? Am I looking at an intrinsic valuation, a pricing, or a real option? And one of the things I'm going to argue for is, don't make this an either-or, that you're a true believer in intrinsic valuation, you will never do pricing. Or you're a true believer in pricing, you will never do intrinsic valuation, because I think there's an advantage to being conversant with all of the different approaches, to being comfortable enough with pricing that you can actually price something even though you might truly believe in intrinsic valuation. So I'm going to start on the intrinsic valuation section, because we're very quickly going to start running into So this is the first lecture note packet. If you didn't bring it with you, that's fine, because starting next class, as I said, make sure you bring your lecture note packets with you. Okay? So let me start off by laying the foundations for intrinsic valuation. As I said, in intrinsic valuation, this isn't rocket science. The value of an asset is the present value of the expected cash flows in the asset. That's it. It's not the only tool for estimating intrinsic value, discounted cash flow valuation, but it is perhaps the most widely used tool for doing intrinsic value. So I'm going to start off by giving you all of the theory you're ever going to see in this class. This is it. This one page is going to contain all the theory we're going to get. That's it. The value of an asset is the present value of the expected cash flows. So the way you will traditionally see a discounted cash flow valuation presented is you'll see expected cash flows in the numerator, and the discount rate is where you put in the risk. That's the most common form of DCF. There's another version of DCF that is practiced less frequently, or when it is practiced badly. And here's what you can do. Rather than take expected cash flows, you can use what are called certainty equivalent cash flows. You think, what the heck are those? Let me give you an example. Let's assume you're investing in a risky business, and based on the risk, you come up with an expected cash flow of $90 million for next year. That's an expected cash flow. There are good scenarios, bad scenarios. With the certainty equivalent, here's what I'm asking you. If I offered you a guaranteed cash flow in exchange for that 90 million of a risky cash flow, how much would you settle for? Now first, you can already see that if you're risk averse, the 90 million is risky, and I'm offering you a guaranteed amount, you can say, I'll settle for 75 million, or 8, that's a certain equivalent. There's that show on TV with Howie Mandel. What's that called? It's a, you have no time to watch TV? Where it's basically, he makes a deal where he's, do you want what's behind the curtain, or do you want $50,000? It's really certain equivalent. So if you want to see certain equivalent in play, that's what I'm doing, is I'm offering you a guaranteed cash flow. The reason it's so difficult is coming up with that replacement for the expected cash flow is tough to do, but if you can, you then don't have to adjust the discount rate. You can use the risk-free rate. And if you do it right, you should come up with the same risk-adjusted value for an asset. So I'm going to close today's class with a very simple exercise in intrinsic valuation. I actually did this exercise when I did my valuation boot camp when you were in your first year. How many of you were in that boot camp? Okay. So don't jump into the answer. You already know the answer. So I'm going to let the people who weren't in the boot camp play along with me. Okay? So I need some guinea pigs here to play along. So here's what I have. I have an empty envelope. I'm going to put a $20 bill. I'm not a magician, so nothing else is going in there. Yeah? How much would you pay for this envelope? He said $20. First rule in valuation. If you pay $20 for an envelope of $20, what do you end up with? An envelope, which I stole from upstairs. So let's try again. There's $20 inside the envelope. How much would you pay for the envelope? That's good. Start with nothing. It's probably asking for too much, but you might say, well, how about $1? You don't know what disease I have. Maybe I can't read numbers. Of course, that's asking for a lot. This is a simple asset. And even Wasserstein-Perella shouldn't have difficulty with this. If I open this up for bidding, my guess is it's probably going to end up at about $20. Now let's make this game interesting. I'm going to put stuff with the $20, and you tell me, so we're at $20. So the pricing is set at 20. I'm going to put in some, can you read to the class what it says? Control. I'm going to put control in with the $20. How much should he pay for the envelope with control in it? Control of what? The $20.
That's meaningless in this terms.
You can never work at an investment bank. You know why? Because in M&A, what's control what? It's almost built into the model. 20%. In fact, a few weeks ago, I was asked to come in and talk to the Goldman M&A group for a re-education program. I did this, and some guy decides he's going to be clever. He offers me 25. You know what I did? I sold him the envelope. He said, I didn't mean it. He said, now that it's not your own money, rather than your client's money, you're feeling a little wary about paying $5 for a, because you know what he did, right? He paid $5 for a 3x5 card that I, again, stole from upstairs. That's kind of a running theme here, whatever. So you kind of see where this is going next, right? So the control you are tough with. Let's try something a little more, what does it say? Synergy. That's a big one. Let me throw that in there. Just another 3x5 card. Just a word. What does it say? Brand name. If you're a marketing person, you're doing somersaults, still $20. In fact, if you're ever trying to sell something for way more than it's worth, the two words that usually work are, the first word is strategic. Right? I've talked about this in corporate finance. When nothing else works, throw the word in. It means I want to do this deal. And the other is China. That's it. I call these weapons of mass distraction. You see why? They're in there because they want you to take your eyes off the numbers. It's China. 1.2 billion people. Put 3 more zeros in every revenue number we have. In fact, I did a study of equity research reports a couple of years ago. where I counted the number of times the analyst used these words. I have a list of 10 words. Weapons of mass distraction. Counted the number of times. China. Cloud computing. I mean, you've seen it. Corporate sustainability. Throw that in there. Right? It's amazing how these words kind of change over time. But basically, they've become words that basically say, I don't know why. You can't explain it with numbers, but you should be paying a premium. So I'm going to call this the IT proposition. If it does not affect the cash flows and it does not affect risk, let's not talk about it. You know how much of the time we waste in valuation is about its that don't matter? So if you want to talk about it, tell me why it matters. The second proposition I call the duh proposition. I've named it after my daughter, who's now 21. But I have 4 kids. They're all pretty much grown up. But I've noticed something very, very disquieting about all of them. When they were about 2 or 3, they thought I knew everything on the face of the earth. They'd come to me with questions like, Dad, what's the meaning of the universe? And I'd make up stuff, and they couldn't read yet. And I'd get away with it. And somewhere around between the age of 2 and 3, I noticed they'd go to sleep one night thinking I knew everything on the face of the earth, and then they woke up the next morning and I knew a little less. And then it's all downhill from there. And around the age of 16, I've hit rock bottom, especially with my daughter, because my son stopped even knowing I was on the face of the earth around the age of 12. My daughter kept focused on me. And at the age of 16, I'd officially become the stupidest person on the face of the earth, at least in my daughter's head. And I had the misfortune, dinner time, to be sitting across the table from her. That's where my seat was. And the conversation, something would come up during dinner, where I thought I had something to contribute. I'd open my mouth, and my daughter would look across the table at me. She said, Dad, duh. The amount of contempt that would ooze out of that word was just so amazing. I'd shut my mouth. I didn't speak for like 2 years. The good news was around the age of 18, one night she went to bed thinking I was the stupidest person on the face of the earth. The next morning she woke up and I moved up the ranks to the 7th stupidest. And I think I'm still climbing. I don't know when I'll peak out. I'm not off the bottom 100 yet, but I'm actually getting pretty close to being off that list. Here's the duh proposition. It's specifically designed for a set of emails I get. Here's how the emails will go. I'm valuing a money-losing company. I expect this company to lose money forever. What valuation model do you think will work best on this company? I feel like slapping the person around the face and say, you're buying a company you expect to lose money forever and you're planning to pay for this company? What's wrong with you? So let's get that out of the way. If you have an asset which will never have positive cash flows, let's save ourselves the trouble. This asset is worth nothing. Which brings me to my third and final proposition. We'll end with this. Can you have a company with negative cash flows up front be a valuable company? In fact, what kinds of companies have negative cash flows up front? Young companies, startups, growing companies. It's often called cash burn, right? That they're burning through cash. By itself, it tells me nothing about the company. I would expect a growth company to burn through cash as long as I expect a disproportionately large positive cash flow in the future to make up for those negative cash flows up front. We're going to value some growth companies, from Amazon in 2000 to Facebook in 2012 to Twitter in 2015. And what you're going to see in common in all of these valuations is you're going to see a front end of negative cash flows. That's me saying, hey, you know what? This is a growth company. It's losing money. I expect it to have negative cash flows. And then you're going to see a really large positive cash flow towards the end as that company becomes a mature company. And it'll tilt the balance enough that I'm willing to pay for the asset. Maybe not as much as other people are willing to pay, but based on its cash flows. So when we start off on Wednesday, we will start to get into the specifics of intrinsic valuation. So if you haven't picked a company, good time to do so now. Preferably now. Trailing 12 months if you can. Because once they've turned the corner, it becomes easy again, right? Once you start to make money, your life gets simpler. So you want to do it when your life is most difficult, and it looks like And then almost any of the young growth companies like Tesla's, the Solar Cities.
That's a quick question. When you talk about the structural equivalent cash flow, you're talking one period for now, or talking today?
Every cash flow.
Because you will say it's 90 million.
But if it's certain, it doesn't matter, right? It'll be the guaranteed cash flow I will give you 1 year from now instead of the 90.
Okay, the guaranteed cash flow 1
The
year from now.
guaranteed cash flow 2 years from now instead of the expected
So
cash flow.
that's why you discount by the risk-free. Okay,
Exactly.
because it's guaranteed from 1 year from now. Okay, got it. Thank you.
Hi, how are you?
Howard,
Hi.
nice to meet you. So I'm actually a part-time student.
Yeah.
I typically have classes at night. That's why I missed the class on Friday because I didn't expect it to be, I should have expected it first, but I still really want to continue taking this class. Is there a TA here I can talk about how I can catch up?
Catch up on what?
On
the
the
class
first
is a
class I missed.
class of webcast. So go into the you have the
Right, I already watched the webcast,
Yeah,
and there was
so-
like an end of class quiz that I
let's just start with solutions.
Was that part of? Was that just like an in-class kind of
No, it's
exercise?
after the class for yourself. That's what they all
Okay.
got the same quiz after the class. So
Okay,
it's not
so
like
it's an exercise, not like a graded assignment.
Exactly.
I also kind of want to talk to a TA about kind of like any kind of prep work I need to do for this class. I think I need to brush up on. Are there any TAs available right now?
Check the syllabus. The names of the TAs are in there with them. See, TAs don't come to class.
Oh, they don't come to class.
So you'll have to email them, set up some time.
Okay, got it. Great. See you Wednesday. Thank you.